Liquidity refers to the ease with which an asset, or security, can be converted into cash without affecting its market price. Liquidity describes the degree to which an asset can be quickly bought or sold in a market at a price reflecting its intrinsic value. Assets such as cash, bonds, and securities are very liquid since they can be converted into cash very easily, as compared to property, plant, or equipment, which take time and are not easily converted into cash. As cash is the most liquid asset, investments like stocks and bonds can also be easily converted into cash, therefore, they are often referred to as liquid assets. Imagine you have a property worth $8 million, you couldn't just sell it tomorrow if you needed that money to pay off an outstanding debt. The company's health can be assessed from understanding the company's liquidity to gauge how able a firm is to pay its short-term debts and current liabilities. The company can also be measured by the amount of cash it generates beyond its liabilities. The excess cash can be utilized in paying dividends to shareholders and grow the firm. Market liquidity refers to a market's ability to allow assets to be bought and sold easily and quickly, such as a country's financial markets or real estate market. The stock market is characterized by higher market liquidity if its shares can be quickly bought and sold and the trade has little impact on the stock's price. If an exchange has a high volume of trade, the price a buyer offers per share, bid price, and the price the seller is willing to accept, ask price, should be close to each other. Investors, then, will not have to give up unrealized gains for a quick sale. There are three common ratios used to measure a company's liquidity or how well a company can liquidate its assets to meet its current obligations. The current ratio. Also known as working capital, the current ratio measures the liquidity of a company and is calculated by dividing its current assets by current liabilities, those converted to cash in less than 1 year. The current ratio is used to provide a company's ability to pay back its liabilities with its assets, and a company should ideally have a ratio greater than 1, which means they have more current assets to current liabilities. Current ratio equals current assets, current liabilities. The quick ratio. Often called acid test ratio, the quick ratio the same as the current ratio but does not include inventory. Inventory is removed because it is not as liquid as the other current assets. A ratio value of greater than 1 is typically considered good from a liquidity standpoint, but it is dependent on the industry. The operating cash flow ratio. The operating cash flow ratio is a measure of short-term liquidity by calculating the number of times a company can pay down its current debts with cash generated in the same period. When operating cash flow is divided by current liabilities, we get the operating cash flow ratio. An increasing operating cash flow ratio is a sign of financial health, while those with declining ratios may have liquidity issues in the short term.